Hi there. Did you know that the new stimulus bill signed in December of 2020 made some attractive changes to the employee retention credit that allowed business owners to get some new funds for their business? If you didn't, stay tuned and you'll hear more about it. Hello, my name is Carmen Huertas from Freedomtax Accounting. We are a tax accounting firm that has been providing quality services to our community for more than 20 years. In this video, we're going to discuss the changes that were made to the employee retention credit that originally came out in March of 2020 in the CARES Act. Okay, this credit was very attractive back then, but it was competing quite a bit with the PPP. And it kind of fell by the wayside because of the restrictions and rules that existed last year. Now, some new changes were made, and it's going to allow a lot more people to take advantage of this credit, which is a really good one. So I highly encourage you to listen all the way through and see how this credit can benefit you because it can make a difference of quite a bit of money. I will be kind of glancing at these notes, so I apologize beforehand because there's a lot of information, and I want to make sure that I don't leave anything out. Okay, so the first thing that we should know about this credit is that it allowed an employer to have a maximum credit for any given employee of $5,000. So the credit was $5,000 over that employee's $10,000 in wages, and that was the max or the cap for the whole year 2020. So regardless of how that $10,000 of wages was earned throughout the second, third, and fourth quarter, the max was 10. Once they reach 10, you can no longer claim the credit for the wages, okay? So it was 50% of wages over a max of $10,000 in wages, and that's why the max, the whole year, was $5,000. Now, there have been some changes, and the first and easiest change that was made was that this credit applied to wages paid from March 13th, 2020 through December 31st of 2020. Now, the easiest change is that it got extended to June 30th of 2021. So you have 2 additional quarters to be able to claim this credit. The wonderful thing about it is that one of the biggest limitations that prevented people from getting this was if you had PPP, you could not get this credit. No matter if you had used up the PPP funds and then you needed this credit later on in the year, you could not do both. Okay, so that was pretty unfortunate, but that has been changed now, okay? So let's start with the basics. Let's just kind of recap what the employee retention credit was about, because we have another video on it, but we'll just kind of, recap it and show you how it changed this year. So how much money does the credit give me? Bottom line, that's what everybody wants to know, because the rules can get so confusing. But bottom line, how much are we talking about, right? So in 2020, like I said, the max credit you could get was $5,000 for one employee for the whole year. That's the max. This year, that max credit is $7,000 max per employee per quarter, okay? So remember, I said it was extended through June 30th. So now you have first and second quarter of 2021 to be able to get this credit. So if the max you can get per one employee is $7,000 in the first quarter, $7,000 in the second quarter, that gives you a total this year of $14,000 per that same employee that last year only gave you $5,000. So that's quite a jump. That's pretty attractive there. Now, who qualifies? There are 2 tests to determine if you qualify for this credit, and the tests have not changed. The first test that you have to determine, and this is aside from okay, you have to be a qualified employer, and that business has to carry a trade or business, in the year 2020, which is when this CARES Act came out, okay? So you must be operating in 2020, and you must be an employer with employees, not subcontractors. Employees are on payroll, and they have Social Security and Medicare that get taken out of their wages. Self-employed do not have these, Social Security and Medicare, so that is not part of this. This is called employee retention credit, not subcontractor retention credit. It's very important to make that clear. Okay, so you must be an employer that carries on a trade or business. Tax exempt organizations are included, but state and government entities or companies are not included, okay? Political subdivisions thereof, they're not eligible for the credit. So aside from that, who qualifies? There are 2 tests, and those tests have not changed. Number 1, were you under a mandatory governmental shutdown order, whether that is full or partial? Okay, so if you are not an essential worker and your business was shut down fully or partially, then you qualify for this credit. The second test is maybe you were an essential business like we in accounting. We could not shut down. I mean, I guess we could, but we were not under orders to shut down. So we stayed open, but obviously everything affected the flow of business. So our revenues reduced, as did so many other people. So if you had a significant decline in revenues, then you also qualify. Okay, so those are the first 2 tests, and those have not changed. The only thing that changed in 2021 is that they made an exception for tax-exempt public colleges, universities, and hospitals that before could not participate, but now they can. That was the only change. Now, what is a significant decline in gross receipts? A significant decline in 2020 meant that you, in 2020, had 50% less in revenues as compared to that same quarter in 2019. So you at least have had to have, a 50% hit in your revenues in order for you to qualify. In 2021, instead of 50%, that was reduced to only a 20% reduction in wages. So again, it sounds, and I'm sure a lot of you feel that you took a 50% hit, but when you look at the numbers, on a profit and loss, I guess, like comparing it to the quarter of the prior year, a lot of people didn't quite make 50%, but they definitely were in the 20%. That's, in my experience, a lot more common. So that's a great way to include more people to be eligible to take this credit, okay? So for example, if in the second quarter of 2020, in the month of May 2020, your business experienced a decline of 60% in May, okay, so that's in the second quarter, then you qualify for the entire quarter, even though it happened in May and not in April, right? As any point in that quarter that you hit more than a 50% decline, you qualify. So you can take the credit for the entire quarter. Now, you can continue to take the credit until your revenues reached 80% of what they were in that same quarter in 2019, okay? So say in May you reached a 60% decline, right? Compared to second quarter 2019. And then you reached a decline of only 10% in August. That falls in the third quarter, but the third quarter ends in September 30th. So even if you reached 10% in August, you still keep qualifying for the entire third quarter, and it would end October 1st of 2020, which is the quarter after you reached 10%, okay? Which is less than 20%, and that's the rule, okay? So I hope that kind of helped you clear it out and understand the rule a little bit better. So you qualify as soon as you reached 50% decline, and you stop qualifying the quarter after the quarter you reached a 20% decline or less, okay? So what if a business started in 2019 but didn't start first quarter? Maybe they started later. They qualify too, and we'll go over some of those rules right here. So say that your business started in, here's some of the scenarios that are here in the chart, right? So you started your business quarter 1, 2019, that's easy. Whenever you see if you're eligible, you're going to compare the first quarter of 2020 to the first quarter of 2019. So that's simple. Second quarter 2020, second quarter 2019, and so on and so forth. But say you started the business in the second quarter of 2019. So here are your options. You can either compare the second quarter of 2019 with the first and second quarter of 2020, or you can compare the third quarter of 2019 with the third quarter of 2020, or the fourth quarter of 2019 to the fourth quarter of 2020. So those are your options if you opened up in the second quarter of 2019. If you opened up in the third quarter of 2019, then you can compare quarter 3, which is when you opened of 2019, to quarter 1, 2, and 3 of 2020. Okay, that's the first test. Or you can decide to just compare quarter 4, 2020 to quarter 4, 2019. And if you started in the fourth quarter of 2019, then you compare 2019's fourth quarter to the first, second, third, and fourth quarter of 2020. Okay? If you started in the middle of any quarter, maybe not in the very beginning, but in the middle of it, then you would estimate your gross receipts, right? You would estimate what that business would have had for the entire quarter based on the gross receipts for the portion that you were open. It gets a little bit complicated, but the point here is that you still have an opportunity to do this test even if you were not open all year of 2019. Say you started the business in 2020, you can still qualify for the credit. Okay? An employer who acquires a business in 2020 may use a safe harbor method, allowing the acquirer to include that, such a business's 2019 gross receipts to determine whether there is a significant decline in gross receipts of the acquirer. But to use that safe harbor, it requires the acquirer to estimate the gross receipts that the acquirer would have had from the business for the entire calendar quarter in which the business was acquired. I probably lost 50% of you. But the point is, you can call us for more help if you need clarification. But the point that I want to make to you is that don't disqualify yourself from the credit if you did not operate all of 2019 or you started in 2020. Okay? That's the takeaway. So, let's go on to the next category here. What are qualified wages? So qualified, after you determine that you meet one of the first two conditions, you were under a shutdown, full or partial, or you had the significant decline in gross receipts. Then you have to look at your company and determine if you have, in 2020, the rule was 100 employees or less. In 2021, that got bumped up to 500 employees or less, okay? So if you're looking at 2020, you see if you had 100 employees or less. 2021, if you had 500 or less. Okay, so I fall into that category. Now what? So if you're in that category, all of the wages paid during the time that you were under that first and second test, all of the wages, whether the people were actually working or whether they were at home and they could not work or telework. If they could not work at all, but you were still paying them with the sole purpose of retaining that employee, all of those wages count towards calculating this credit, okay? So there, the change was from 100 to 500 or less. If you had 101 or more employees in 2020, or in 2021, if you had 501 or more employees, you still can get the credit. However, the credit only applies to wages paid to an employee that is not working and they cannot telework. So they're at home, you're paying them just with the hopes of retaining that employee for later on, okay? So if you're smaller, you can get the credit on all the wages. If you're larger, you can only get it on the people who were not working and you were still paying, okay? What is included in wages? What do they mean by that? So wages is obviously their wages or whatever you pay them, hourly or salary, plus qualified health plan expenses, which are costs that are either paid by the employee with pre-tax dollars or paid by the eligible employer. So that calculation also gets added on to the regular wage, and you get 50% of all of that. 50% was what you would get in 2020. 2021, the credit was increased to 70%. Okay, so that's another very, very good bump. Remember I said in the beginning, the max on $10,000 per employee was $5,000. This year, the max is $7,000 on the same $10,000 in wages because the rate went up, the percentage went up from 50 to 70%. That's a big one. So how do I get the credit paid to me? In the past, if you want to go retroactive, which you can, if you determine looking back, oh man, I really would have qualified the entire 2019 or second and third quarter only, whatever your case is. If you determine that you qualified, then you can go back and amend the 941 for that quarter, and you can, claim the credit that way by amending it. The new 941 has lines, I don't know if you've noticed, but it has lines for this credit. If you still have not done your the fourth quarter 941, the payroll reports that are now being processed, and a lot of them have been submitted in January 2021 for the fourth quarter of last year, if you have not sent those out yet, you can actually claim second, third, or fourth quarter on the fourth quarter 941. instead of having to go to each individual quarter. Now, it's a little too late for some people. Many people have already submitted the 941. If you have already submitted it, then you're just going to have to go back and amend whatever quarter specifically it was that you qualified in, okay? At the time that you request this credit, the IRS doesn't require you to show like any type of proof or documentation. However, whatever you use to determine that you qualify, payroll reports, you know, whether it was the decree at that time from the state that you had to close or shut down, you know, anything that you have to support your decision to claim this, you should definitely keep on hand and save it for at least 4 years. That is the requirement for documentation on this, okay? Now, moving forward, you have first and second quarter that we can claim this credit. Now, what do I do then? You have two options. There's a form called 7200, which we also have a video on regarding. The form 7200 was designed for business owners to claim an advance on this credit. What do I mean by that? So the way that this credit works is that you get 50% in 2020, 70% of the wages now. So moving forward, it's 70%. Whenever you determine how much that is, right? The first thing that credit is going to pay or eliminate is the employer portion of the Social Security and Medicare withholdings from the employee. Okay, so if you had payroll and you had, you know, $800 of the employer portion, Social Security and Medicare, but the credit was actually $5,000, then the first thing that it eliminates is that $800, okay? That you don't have to pay. So whatever payroll tax deposit payment you normally make, it would be reduced by that portion. But you had $5,000 in credit, okay? So obviously it covers $800 and there's plenty left over. So say your full payment, that 941 payment that you would make on EFTPS, say it was supposed to be $2,000. You have $5,000 in credit. So the immediate way that you get the credit is by not paying the $2,000 tax deposit, okay? And you're not gonna get penalized. Normally, if you don't make timely tax deposits, you get a penalty. But if you have this credit, you don't have to make the payment. That is the immediate way that you have that money in your pocket, is by not having to spend it. Now, you had $5,000 in credit, you did not make a $2,000 payment, so you still have $3,000 that they owe you now. And that's where you would file the Form 7200, because if it's not April yet, which is when you file the 941 for the first quarter, and you want the money in advance, you would file Form 7200 to claim that in advance, okay? So you didn't make the $2,000 payment, the $2,000 is now in your pocket to spend on whatever, and they owe you $3,000. Form 7200 gets you that additional $3,000 in advance. If you're just too busy and really don't have time to file Form 7200 and you make it all the way to April, which is when we file the first quarter reports, you've made all of your tax deposits, business as usual, well then on that 941, not Form 7200 in April, in Form 941, then you would go ahead and just claim it on the 941 so that you get a refund of whatever you paid. Okay, so it's better to do it in advance, because then you don't even have to spend the money to begin with. Because although the credit is wonderful, it can take some time for them to actually cut you the check, and you will receive the money in a check in the mail. So that's how you get it. It's not direct deposited, you will get a check. And of course that takes a couple weeks with tax season, with all the other credits and PPP stuff and all that. That's, you know, in the atmosphere. Obviously the IRS gets bogged down, they're human too, and it takes a little longer. So the best way is to figure out early that you qualify and not have to make those tax deposits, okay? So I hope this all made sense. I tried to be brief. I just tried to recap, because if you read the law and you go, you know, it's a lot of information and it's very confusing. So if you have any experience with this already, if you've already applied for it and have actually received the credit for 2020, leave your experience down in the comments. Let us know how it went for you. Other people can benefit from your experience. If you have any questions, please comment below. We also take a look at those and try to answer all the questions there in the comment section. And I really thank you for sticking all the way through and watching the video. If you've come up to this point, then you're getting some value out of this video. And I'd like to ask you to hit the like button on the video and also subscribe to our channel so you can stay up to date with all the changes that are continually coming out. And I sincerely thank you for watching, and I hope you have a great rest of your day. Thank you.